Okay, here's some more problems, and I'm just going to talk through these rather than try to do them all because some of them are more spreadsheet work than just thought experiments. But so this one is basically just you got to figure out the cash flow every year, and then for over 8 years, and then discount that back to present value. So, this is a little bit just like a crossword puzzle or a puzzle of some sort. You just got to pick out the information. So they say they use the existing warehouse, which is being rented out to the neighboring firm. So, for $100,000, increasing at 4% a year. So for me, I would use that. So the rent as $100,000, increasing at 4% a year. As one of the cost, even though they own the warehouse and they aren't going to pay rent to themselves. That's an opportunity cost. So they're going to have to terminate that lease, and so I would consider that rent a opportunity cost. So it's not a hard cost, but it's still a cost to the company. So they need an investment of 1.2 million. So that would be at time zero at the very beginning of this 8-year period. So that doesn't get discounted. That would be the full value. Here they say depreciated straight line for 10 years, so that's $120,000 a year of depreciation. Now that's a non-cash expense, so the only way that affects the cash flow is it reduces the taxes once you get down here, if it does talk about taxes. I can't remember if it does. If it doesn't mention taxes, then that may be sort of a red herring, because depreciation is just an accounting entry. There's no cash that goes out the door, and when you're talking about net present value, you're normally thinking about cash flow, not accounting net income. You need to says they expect to terminate the project at the end of 8 years. So that's going to be, you're going to do 8 years of projections in your spreadsheet, and resell the plant and equipment in year 8 for $400,000. Again, if there's, they do mention taxes. So, okay, you will need to take account of the depreciation. That will reduce the taxes for 8 years. But then at the end of 8 years, there'll be the depreciated value of the building will be $240,000, because you'll have 2 years of depreciation remaining after 8 years. So that's $240,000 remaining. But if you sell it for $400,000, then you're going to have a gain, because the depreciated value is $240,000. So you're going to have a gain of $160,000. That would be subject to this 35% tax. Doesn't mention anything here about capital gains tax rates, just this, so I would apply that. So you're going to have depreciation that reduces taxable income. Years 0 through 8, and then a gain on sale of asset. Year 8, this is $120,000 a year. This gain will be the $400,000 less the 240,000 remaining depreciated value. And of course, these are all computed at 35% tax rate. Remember, we're talking about the total profit from, or income from the project, not just it's not just 0.35 times 120,000 a year. That's just a deduction made from the income. It requires initial investment of $350,000 in working capital, so that would be, again, a front-end expense, much like this $1.2 million, except that you can't depreciate working capital. So it's just going to be $300,000 outflow at time 0, and then the working capital would increase at 10% of forecasted to be 10% of sales each year, 1 through 7. So for every year, you would compute the new working capital number at 10% of sales in your spreadsheet. And then the cash flow is not the absolute amount of working capital in every year, it's the change in working capital. So for time equals 0, since you start out with 0 working capital, and here it's saying you have 350,000 initial investment. In that case, it will be the 350,000, just because the change is from 0 to 350. But then for subsequent years, 1 through 7, the cash impact of working capital is just the change in working capital. Okay, let's keep working through this. Sales will be expected to be 4.2 million and grow by 5% a year, so slightly faster than inflation rate. So you just put sales in at 4.2 million, increasing at 5%. Manufacturing costs are 90% of sales, so I'm going to call that cost of goods sold is 90% of sales. In other words, you have a 10% pre-tax margin. Carry that out through your spreadsheet, and then you'll have your tax, which will be your sales minus cost of goods sold, minus depreciation, which will give you your earnings before tax. Let's make sure we've accounted for all the expenses here. Yeah, you would not, going back to this warehouse cost, since that's an opportunity cost, you would not deduct it from earnings before taxes for tax purposes. Again, you can make the argument not to include that at all, but I think it makes sense to include it. But I can see the argument for not including it as well. But EBIT times the tax rate, which in this case is 35%, would give you your tax. And so that's another expense. So you end up with expenses, tax deductible expenses of cost of goods, tax deductible expenses of cost of goods sold, depreciation, and that will give you your earnings before taxes, and then your tax will be a cash expense. And then I'm going to argue that this should be, although it's not a cash expense, that it should be included, but you might ask the professor about that, how he or she feels about that. Okay, so that's problem 6-21, my thoughts there.